welcome back, goons, to another episode of Jack of All Trades. Today we're gonna just focus on one main topic. We're gonna talk about the commonalities between professional gambling and trading, because I think having done a little bit of both, there's quite a bit of similarity between the two of them. So yeah, Caitlin, you said you don't have any experience with gambling?
No, I mean, I play the slot machine every now and again, but that's about it. Pretty much only when I go to Vegas. It's funny though, like whenever I do gamble, I always I've never been like one to lose money. I always go in there and I'll have like $100 or something like that, and like that's the most I'm willing to lose. So like if I go down to zero, I'll just can it. But like the way that I used to always play, like when I was just playing slots and stuff like that, is like if I would win money, I'd always put my original $100 back in my wallet. I wouldn't touch it again. So like I'd go in there, and if I hit like a little jackpot and made like $200 or $300, then I would take the $100 that I started with, put it in my wallet, not touch it, and just play with the rest of the money. And then if I started to get back down again, like if I got within like $100 of my original position, then I'd just leave, because I'd be like, in my head, I'm like, okay, the casino always wins, and I want to go out here with some money.
So you totally approach it as like a activity that's pure luck.
Oh yeah, yeah. Well, I'm playing slots, right? Like it is pure luck. I
True.
never know how to play any of the card games.
Yeah, you're right.
Because you
Sorry.
play, like, what's your background in poker and stuff, right? Like you
So
used to do a lot of poker.
I did, but see, I should start with the fact that I'm Chinese, and Chinese are known to be gamblers. Like you see those buses, they
Really?
take. Yeah, you have those tour buses. They just take all the grandmas and grandpas down to like Niagara Falls or wherever, because it's like this is a big business, and it's like because Chinese
Yeah.
culture is huge on like fortune and like destiny and all that shit. So they've been pre-wired to be gamblers, which is horrible.
Hmm.
And I know some families that have been ruined by it, but but so like growing up, my friends were in high school. My friends were Vietnamese. As soon as we were of age, we started driving down to Port Perry. We started playing cards, and then the first game I started to play was Pai Gow, because even then I looked at the table and I was like, the most even game I could find there was Pai Gow. It was like almost exactly 50-50 between you and the house. And so the only way the house could take any money from you is every time you win, they take a little bit of a commission.
Okay.
So and it's
So it's
basically
like
like
trading.
yeah, exactly. And it's basically like 7 card poker with it's basically 7 card poker hands with 2 extra cards. So that was my first foray into gambling, and then when Poker Stars came out, when it went online, that's when I really started playing.
Okay. So what's
And
your
then
what's your like kind of like walk me through like your thought process. I'm kind of curious. Like when you're playing a game, when like you think you're gonna win, like when you lose, like what are the kind of the similarities between that and trading?
so I think the first thing is just like trading. Don't look at well, especially with poker. It's there is obviously luck involved, but like it's a lot like trading in that it seems like gibberish to anybody that's informed and uneducated in the area. But once you kind of know some of the strategies and you kind of understand the ins and outs of it, then you start to realize, yeah, there's actually a lot that I can do to maximize my chance for profit, or maximize my chance for winning. And the biggest similarity, and I think you would agree, is that the first thing that I learned was that you got to fold almost every hand. Like you only play like the high probability hands, right?
Yeah, I
And
was just
so
gonna
like,
ask you that because I was gonna say, I don't know anything about poker, but that's what I was thinking. Is like, when you're trading and stuff like that, they always say just because you're at your screen doesn't mean you have to take a trade, right? Like, you and I, like when we trade, we'll wait and wait and wait and see if something shows up. And if something shows up, depending on the probability, like depending on how much we like, it kind of determines how much capital we'll risk, right? So if you see those like super high odds setups, those are the ones that you go big on. Ones that are, decent odds, you might go a little bit smaller, and the ones that are kind of like 50-50, you just don't even touch them.
yeah, exactly. And just like trading, there's edges. So there's one edge in cards. I would say there's one edge in terms of cards, and there's one edge in terms of um, playing the player, I guess. And so the edge in cards is easy. Like there's literally so many combinations of cards you could be dealt, and then you would know which ones are high probability to win, and then that's where you fold. Because like I will just keep folding until I get one of those high probability hands. And then so it's a battle of like attrition, basically, like because there's small blind, big blind. So I'm losing every money a little bit every cycle. And so I might lose money
Mhm.
for 15 straight games before 15 straight hands before I have a playable hand. But then so you have to make that one hand worth it. So that's one, just knowing the probability of winning with each particular hand that you get. And then the second thing is psychology. So you got to know the table you're playing at, because if you know the players you're playing, then you can get a bit of an edge too. So the reason I like poker, so I'm okay live playing, but when it's online, I'm a lot better, and especially in tournament. And so like when I'm playing online, because you can't read the other person's facial expressions, what I learned to read was their timing. So like, what's great about PokerStars is that you can actually write notes about the other players and just kind of reference it. So a lot of times I would just fold a bunch of hands, but I'd be watching each player and seeing like the size of their bet and how quickly they made that bet, and then I want to see the cards they had when they made that bet. And so you kind of get a profile of each player. Like this guy, it's high risk. This guy, when he slows down and thinks about it, he's really trying to get you to think he's thinking about it, but he's got strong hands. Like there's little characteristics, and so those are really important. So then once you know the people that you're playing against, and then you know obviously the cards that you have, and it becomes a little bit easier to win.
Yeah, super interesting. It's almost like you're basically just like learning a pattern like you would in the stock market, only it's like the way a person actually is going to play. It's the exact same thing.
Actually, never thought of it like that. Yeah, it actually is. It's like,
Yeah, 'cause, like when you look at it, like if I'm thinking of the way I trade and stuff, like I'm looking at a pattern and I'm looking like okay, like when I'm watching something happening, I can see that this is a bunch of people chasing like I know what people are doing, like it's a bunch of people chasing the stock up or panicking out, or it's stop loss is getting hit or whatever, and I can react based on that. So it's almost kind of the exact same thing, only instead of I guess it is the same thing if you're doing it online, because if you're in person, you're actually seeing the person like
yeah,
firsthand. But if you're on Poker Stars, it's almost identical. Like you're basically seeing like how fast they make moves and what the outcomes are based like through the computer. You're trying to read their psychology. That's kind of
that's
funny.
100% it. Yeah, 100%. And then so then there's where one area where you can get an advantage. So let's say you've got a table mostly full of tight players. So they're smart, they're cautious. So what happens is if I'm the big blind, which means I'm already money in before I even see the cards, right? By the time it comes back to me, if I see a bunch of folds, like more than half the table folds, and I know the three left are kind of like tight players, I'll raise. I will have garbage. I might even look at the cards, but I'll raise because I just want to force them out and just take the blinds. And quite a bit, and quite often
Mm,
that just doing that will pay for my next couple of rotations.
okay. Until you get
So
a really
there's
good hand.
yeah, until I get a really good playable hand. And then when you get the playable hand, you kind of milk it too. And then so the reason I like playing tournament is because there's a finite amount of time. The dynamics change when it's just a cash game because guys can keep on buying back. And so sometimes they're not as afraid to make certain moves. There's not as much on the line. I need as much on the line as possible for them to feel like there's some urgency. And then it's easier for me to predict how they're thinking.
Okay.
Right. Because a guy could be super rich and he could be at like a 1-2 table and I have a decent stack and then he goes all in. You're like, he's out, and then he just comes back with another stack. I'm like, fuck, okay, he's got unlimited cash. Like, so then it's
Yeah.
a little bit
Yeah.
harder. But
Okay.
what I
That's
what
interesting.
I, but what I learned about poker, and I think is 1,000% applicable to trading, is there was this book. It's called Thinking in Bets. I absolutely love it. She's a female poker player, professional player, and then she learned this thing called resulting, which is a bias, which is we judge the quality of our decisions based on the result of those decisions. And so if you make a chain of decisions with an expected outcome and the outcome happens, you naturally think, okay, well, that was the right chain of events and that was the right chain of decisions, and then it works. So then it starts to reinforce in your head that this is what to do to get this result. The problem is when it comes to something as complicated as life, or even not as complicated as life, but still complicated like poker, oftentimes a lot of your decisions have very little bearing on the outcome because there's like eight other players. So their decisions have a lot of bearing in the outcome as well. Like what cards they decide to fold and whatnot. And so the fallacy is that one, you could get tripped up thinking that you made the correct series of decisions based on the result that you wanted, or sometimes you can make the absolute perfect decisions from A to Z and still not get the result that you want because it's just life. Like it's just you just have no control over it, right? You can make every decision, and at the end, the card that you didn't want, the one card in the deck that will fuck you over, came out, and it's like, uh,
Yeah. That's so funny, man. I think that's why like there's so many similarities between that and trading too. Is like it's so hard to learn and so hard to get good at because it's so backwards to like how people are designed and how we're designed to think, right? Like think we talked about it last episode when I was saying like it's the same thing in like stock trading. Like I can see, a perfect setup that I know, pays off 99% of the time. Go in big because it's like this always works, and then you get blown out. And it could be like you go back and you research it like I always do, and I'm looking at it. It's like everything was perfect, like everything lined up exactly the way it was supposed to, but for whatever reason, it just stops you out and you end up taking a loss on it. So it's the same kind of thing. Like it's just, but that's the probability game, right? Is like that's why it's so difficult for people to I think become like professional traders or poker players or whatever, is because like if you think about, I don't know, I'm trying to think of another job. It's like if you learn how to, let's just say you learn how to drive a boat or something like that, or like you learn how to drive a car. It's just like like when you hit the brake, your car is going to slow down. Like
Yeah.
when you hit the gas, your car is going to accelerate. Like that happens 100% of the time, right? Unless you're on ice or something, but that's besides the point. But outside of that, like if that's what you do, or like if you're running, let's say you're running like a machine, like you're like working a factory, or you like run a chainsaw or something like that. It's like what the outcome is when you use this tool. Like it's the same every time. So you learn that and you expect that and you get used to that. Whereas like, imagine you were driving a car one day and like you're going up to a set of lights and you hit the brake and the car accelerates. Like that would just throw your whole world for a loop. You wouldn't know like what the hell's going on. Like you go back to the drawing board, it's like none of this makes any sense, and then you're scared to even get in the car again after that, right? But like as a trader, as a gambler, it's like you have to realize that like sometimes when you hit the brake, it's gonna accelerate, and you just have to realize that most of the time when you hit the brake, it's gonna do what you want it to, but you still have to be prepared for those, that 5% of the time or whatever it is that it's gonna do the complete opposite. And you just have to be able to go back into it the next day and essentially pretend that didn't even happen and just play it like the way you would have regardless.
Yeah, I think you just reminded me like a characteristic. I'm trying to summarize it, but like I think successful traders and gamblers need this characteristic of being like to like kind of look outside of themselves, I guess I'm trying to say. Like you're trying to you can
Mhm.
assess your decisions kind of objectively, because otherwise how would
Yeah.
you see outside of the situation, right?
Yeah. Well, it's funny. I just like it's kind of unrelated, but also not too unrelated. And like I'm not going to go into detail, but like obviously it's the 20-year anniversary of 9/11 right now. So I was watching one of those documentaries the other day, and there's like 10 of them that just came out on Netflix. But
Yeah.
like like I remember it vividly because like I was in school, we watched it on TV and everything. So like it's obviously a big thing in everyone's mind. And when I can't remember the exact details, but basically the documentary I was watching, one of the ladies that was in Congress, they passed a bill that essentially allowed America to go to war with anybody, and it was like there's a lot more details, but long story short, it was basically like no rules, and they could go essentially do whatever they needed to do to stop the terrorists, right? And she was the only person, and I think there was like well over 100, it might have even been 200 Congress people that voted like all for this, and she was the only person that voted no. And like she was the only one that was in the documentary, but it was just interesting because when she was talking, she was saying like, I she was saying how she was upset and she didn't agree with everything and she was on the same page as everyone else. But her standpoint was basically like, I'm trying to look at this completely objectively. Like she's like, I'm upset too, but I'm trying to not be upset so that I can think of this, from an outside perspective, look at the long-term implications, like where is this bill going to put us 20 years, 30 years, 40 years down the road if we allow these rules to pass, right? And she was the only one out of everyone, and she said she was getting like death threats and all this kind of stuff. So it's like extreme example, obviously, but like
Yeah.
I think that's just kind of speaks to our point is like the ratio. You're talking 1 in 200 people who was able to, whether or not that was the right vote or not is besides the point. But it's you have 1 in 200 people who's sitting there saying, okay, like I'm upset, but I need to sit back and think about this objectively and what are the long term implications. So you're looking at a half a percentage of that group of people that's able to think like that objectively. So that's why I think it's such a tough thing to do to be a trader, a professional poker player, or whatever, is because you always have to think like that. And even when you're angry, even when you're frustrated, even when you're stressed, you have to be able to like immediately pull yourself out of that and like, look at yourself like the coach standing over your shoulder and being like, no, 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 like what's the right thing to do? Like, don't act on impulse here.
Yeah, yeah. Acting on impulse gets well, almost never leads to a good thing. Which leads me to another common term in poker that I think is common in trading, but I don't know if there's a term for it. It's called going full tilt. Have you heard of that term before?
Mm. Is that just like going all in?
No,
So loading the boat?
it means losing your shit after you lost.
Oh, it's just like getting mad and flipping the table over. And
Right, because like we were just saying, like people like things to make sense, and we like order and predictability. And then like even among the
yeah,
best players, you're like, I do everything right, and I still lose. Like it's just a human thing to get to flip out. And so going full tilt is a common thing. I've gone full tilt quite a few times, where it's like, I played a, I just lost a series of hands that I should have won, or I lost a hand to a complete moron, and I'm just like, you don't deserve this, and you took my money, kind of thing. Whatever the trigger
yeah,
is, you go full tilt, and then what leads to that is like it just completely undermines your decision making from that point on. And it's like if you realize you're going tilt, you need to stop and walk away. But 99.9% of the time, you're like, "Let's go, motherfucker! I want revenge."
yeah, yeah. And then you lose every time because it's like it's such a human thing, right? Like, like we were bred like fighting for our lives in the wilderness. Like that's how humans evolve, right? So like our natural reaction when something happens that we don't want to happen or we're upset is to fight. Like we want to attack because it's like, we can just give everything into this and like battle and win at the end of the day. But like if you're sitting there, with a hand of cards or you're sitting there at a computer screen getting angry and screaming doesn't affect the outcome, right? But that's like our instinct as humans to do that is to get upset and get aggressive. But this
Yeah,
is one of the few things where it literally does the complete opposite every time because you can't think straight.
yeah, yeah. And then I'm sure this probably happened to you, but it definitely happened to me, which is like when I go tilt in trading, like sometimes you know how like let's say you're shorting a stock, you're short, it goes long, you're like fuck it, like go long, and then it goes short, and it just you're just never on the right side of the trade.
Yeah. I've
It's like
definitely done that quite a few times. My limit is three. Like, once that happens three times, then I'm like, fuck it, I'm done with this stock.
yeah, that's one of the most hilarious ones. It's like apparently it's probably like a universal bias or whatever it is. Like it's hilarious.
That's worst, the absolute worst feeling because it's like you get stopped out short because it's perfect, and then it like flips up and it breaks all the resistance, and then it's like holding higher, and you're like, oh, this is definitely a long. It stopped me out short, and now it's holding up here. And then you get it long, and then it tanks, so you're like, okay, well that just trapped all the long, so let's go short, and then it whips back up again. Oh
So
yeah,
I think this touched on something else too. Like I think there's two types of people this happens to. So I think there's the type that didn't really do too much research. It's just kind of like just trying to like intuit their way through the market, and they're like very beginnerish. And then there's guys like us who I think suffer a little bit more because we're like, let's say we were short and we had a thesis and we thought we were right and we were wrong. It goes the other way. Then we start looking through our work, like, holy shit, where do we go wrong? Like, you know what I mean? Then we start looking for reasons to say that, oh, okay, this is why we're wrong. And then now it's going up. And then so we go the other
yeah.
way and it goes back down. You're like, and then that's what makes it worse.
I know. That's probably one of the biggest skills is trying to learn how to like walk away. Like if you take those losses, like being able to just be like, okay, you know what? Like the markets are going to be open tomorrow. Like everything's going to be fine. Let's just leave, turn your phone off, and come back the next day. Like it's really hard to do because like you never want to, like nobody else in the world goes to work and can lose money by the time they come home. Like every single person who goes to work makes money by the end of the day, right? So
Yeah.
like that's the other thing is like when you go to work, like, you basically go to work and you lose money. It's like, it's not a good feeling because it literally would have been more beneficial for you to stay home and take a vacation day,
Yeah.
essentially. So it's such a weird thing, but it's just all those little skills you have to teach yourself. But like, I think the core basis from that, even from like, from your perspective in poker and stuff is knowing that you know how to play, right? Like if you're not confident, then I don't think that you could ever be successful in either of those things because you have to believe in yourself and you have to believe in your systems. Because if you don't, you might kind of get on like a little bit of a track where you're having like a bit of a winning streak. But then as soon as you take one loss, if you don't like truly believe in yourself and believe in your systems and you're confident in yourself, then you're immediately just going to fall apart and you'll be way back where you started again. Like I've
Yeah.
been there. Like it's happened to me a few times until I actually like built the confidence and the data set to know that what I'm doing works.
Yeah. And the thing is, I think having done both, I would say poker's meaningfully easier than trading. Just because I think there's a lot less variables. Like the fundamentals are still there, the challenges and the strategies, but in terms of how much randomness is involved, I think it's very controllable. Because I know the times where like I've lost, it's much easier to walk away or identify like where it went wrong. But with trading, man, it's like there's so much to look at. Like it could go wrong in so many different ways, either from both your end and from the chart's end, right?
Yeah. Yeah, it's kind of a tricky thing. That's why I like to try and like keep it simple too. It's so easy to get overcomplicated, and I think everybody who's new kind of falls victim to that. Is where like, you kind of get on the basis. Let's say you have a system where it's like, you have a couple moving averages, and your daily candle chart or whatever, and there's like these 5 or 6 little like triggers that when you see these things happen, like, okay, that's my signal to go long or go short or whatever, and then all of a sudden it reverses and it stops you out. Well, like, I've been there where you start to go down that rabbit hole and like, go through Twitter and like figure out like why people are saying it went the other way. And they're like, oh yeah, it's because it broke this, like Bollinger Band or whatever. And then you're like, oh, okay, well, I need to put that on my charts. And then you put that on your charts, and then you're like, okay, I kind of get it. And then you're kind of like trading based on that. And then you lose again and you're like, oh, well, I must be missing something else. And then you try, but like sometimes you didn't miss anything, right? It's just one of those fluke things that just stops you out or whatever. So you got to kind of ignore all that, because you can get to a spot where your chart just looks like, complete chaos, and there's always something that's going to contradict you. So
That reminds me. So, what I was saying about poker being easy, the biggest thing is just understanding the pot odds and your hands, and then the rest is like actually. So we can touch on this later, but like managing your pot, your stack is just like portfolio management, or like bet sizing. But this aspect, like just knowing the odds, is like the most important, or the core fundamental. Where I think like with trading, it's like so you maybe I don't know how many different strategies you've learned, but like when I got into it, I started looking at just reading candlesticks, then it was traditional chart patterns, and then it was like support resistance lines, and then I started going balls deep into Elliott wave, and then I looked into Bollinger Bands, Ichimoku clouds, you name that thing, and I've at least looked into it,
yeah,
and then I found myself having like a bazillion things in the charts, and what ended up happening was it was the same thing. It ended up being the same result of looking at an empty chart, which was everything looked possible based on
yeah,
the indicators.
yeah, exactly. That's why it's so funny. Like when I look at my charts now, like people that are less successful at trading than I am, like will look at my chart and say like, oh man, like that's all you have? Like, what are you, a beginner? Like, and they kind of like look down on me because I'll have like, 1 or 2 indicators on my chart, and like that's it, depending on what time frame I'm looking at. And it's kind of like, oh, like that's all you use? Like you're not worried about what it's doing on like the 73-day moving average and like this and that. Like,
Yes.
no, like like I literally, like, to be honest, 90% of my decisions come from literally just the chart pattern itself. And then I have a couple indicators that I kind of use as like confirmation. So like
Confirmation.
if I see something setting up, let's say it's like a daily chart thing, and it's like, it's over the 50-day moving average, it's over the 200, which are the only two that I have on my charts, and I see a good like daily chart setup, then I'll say, okay, well, like it's in this spot, the daily chart looks good, so like I'll go long. But like if I see that exact same chart setup below both of those moving averages, the only time that I won't take that same trade is like if it's really close to the moving averages, because then I know that they add a little bit of resistance. But if it's like far below, then I'll still take the same trade, and my goal will be to sell into those averages. So it's not like I'm not like, if it's not the perfect cross or the perfect setup, I don't trade based on moving averages. I use them as like rough indicators as to who's in control and like how far I should let my targets go. Like if we're over those, I'll give it a lot more room to go long. But if we're under those, I'll take profits a little bit quicker, because I know that it's, overall it's kind of heavy. That's like really the only, like that's all the only factor they have in the way that I look at stuff, really.
So I just had a thought, and I want to see if you agree with this. Like, because you just made me realize something. Like, when we're first starting out, all these things that we're learning, we almost treat them like as if they're like hard rules. Like a resistance line is a line, like it can't be broken, kind of thing. Or like in moving average, like it's gonna bounce, it has to bounce. They always bounce, right? But the truth of the matter is, like those indicators are like almost like a suggestion or like a point of interest. They don't really
Right.
hold any, you know.
No, they don't hold any weight. And like that's why like one of the biggest things that I started to learn was that when you are looking at those resistance levels, if you're trying to dip buy or short into a line or whatever, that's why it's always best to start in really small and add to a winner. Like that's the way that I've always started playing, and I've had way more success because like I mean, to be completely honest, like I could probably make more money in individual trades if I just went all in on these lines. But I know that the times that it blows through those, my loss is going to be so big that it's going to wipe out like potentially weeks worth of profits. So like what I've started doing is like if I'm trying to enter short at say like $5 and then like, my target is say 450, like I'll put maybe instead of putting, a full size order at $5 and then potentially having to stop out at 550, then, I'll put like a tiny bit on, maybe like a quarter of my size or even less at 5. And then if I see it just, straight tank and I don't have a chance to enter it back in, then that's fine. I'll just take that. Or like if it bounces, it comes back up a little bit, then I can just add in more. And then if I really start to see it fail, then I'll get in full size. But like I might not be in full size until like say 470 and my target's still 450. So like arguably I'm not making as much money on individual trades, but it saves you if you look at the numbers over a long period of time, it saves you in the long run because you're not going all in every single time on those levels because I know that when I do take those losses, if I am all in, then it ends up being way more of a hit to my profits, like weeks worth of profits as opposed to like a day or less than a day.
Right. Actually, you just made me realize I just realized there is a difference between poker. I can't seem to equate it. And it's kind of like the sizing thing. When I'm making bets, a lot of times I'm not the size of my bet doesn't have a lot to do with how much I want in return or even risk. I was using the size of my bet to kind of like almost poke the other player to see what they have. So like
Mm.
I will look at the table, the cards on the table, and then you kind of know what hands are possible because based on the fact that they're still in, you have to assume that they have something, and then so if you assume that, then what you want to know is how high or how strong that something is, and the only way to know that is put out a strong bet. You put out a weak bet, then you're baitingly put on a strong bet, right? Right. So I would use like a strong enough bet that would feel like it's bait, but also strong enough to show strength, and then if they bet over me, I'll be like, fuck, this guy might have me, kind of thing. And I
Mm.
don't think there's a comparable in trading.
No, because you can't really like you're not deliberately baiting people with your orders. I
Yeah.
guess the only kind of similarity I could see is maybe like hidden order size. If you're doing that, because like when you make a trade, like you can like if I make a trade and I want to buy like 10,000 shares or something, I can have it display as like 500 shares, so
Yeah.
that if it's coming down to a line, you'll see on the tape going through, like you'll see like 500, 500, 500, 500, whatever of like my order being bought up, but like my order will just sit there and it won't move because it'll show 500, but you'll see all these orders getting executed, even though there might be like a 10,000 share bid sitting there. So then if people are
Yeah.
seeing that, then they'll be like, oh, we don't know how, like nobody knows how big that position is. So a lot of people will see that and then start buying, and that's when you get a big squeeze happening. But you can really only like you can't do that on stuff that has like crazy high volume, like unless you have a ton of money. There's more so back in like the OTC stock days where like you're not trading huge volume sizes, and if you had like even the guys that had like a couple $100,000 in their account, like they could do that, where like they just put like 100,000 share order on something that's like a $2 stock, and then it'll come down to a certain resistance level, or like even just below a resistance level is kind of like a nice way to do it too. Like let's say like $2.50 on like an OTC is like that's like your last support, and then it goes down to like 245 or something. You get like 5 cents below that. Everybody starts to hammer on short because like on OTCs it was like the line was the line. Like it was literally like if it went 1 cent below or over, like you get in right then and there because it's just going to go. And then what guys will do is you put like a massive order, like a few cents below, so everybody jumps in short. And like if you haven't, only if you have enough money, it's kind of gutsy. But like if you have enough money and you can accumulate all those shorts, then it'll flip around and it'll go long, and all those guys will have to stop out. And it's really hard to get out when it's moving like that in OTCs, and it would just go and go and go and go and go, and you can make a ton of money.
I got a question. Those days you're playing OTCs, maybe even small guys, but probably mostly OTCs. Do you ever
Mhm.
do you ever notice a whale playing there with you? Because you're looking at the level twos, right? Do you ever notice like
Mhm.
buy walls and sell like giant buy walls and sell walls, and then they'll move and kind of disappear sometimes?
Yeah, you see that on listed stocks too.
Yeah. So I'm not 100% informed on how it works on the equity side, but on the crypto side, it's a really shady business. These guys are market makers, and so a lot of
Hmm.
times now they're more institutional organized, but back in the day, it used to be just a whale. And what they do is like, let's say you wanted to open up an exchange, um, and the problem with opening exchange is like, where's the liquidity coming from? And so like a whale will come around. Let's say the whale is doing has a lot of Ethereum. They become the market maker. So they'll have an agreement with the exchange and say, yeah, I will provide the liquidity. You're going to provide me with some trader data. And so what happens is
Right.
they'll play the bottom and they'll play both sides of the game, right? And then so when they
Yeah.
have like a buy wall, it means they want to sell into you. So they make
Right.
that wall there, and everybody's bids has to be above it. And they'll chase it up, chase it up, chase it up. And when they've dumped all their bags, they create a sell wall, and suddenly they chase it down. And where it's
Yeah.
unfair is that they're getting the data from the exchanges, so the exchanges know where everyone's stops are. So if everyone's experienced that thing where like the market's going and they stop you out and it goes back, like that's what happens.
Yeah. Yeah. I see those a lot, man. Like there was one, I think it was one like I saw it was like 2.5 weeks ago. There was one stock, I can't remember what it was, but it was like a $4 or $5 stock. And like pre-market highs were I think like call it like $4.80 or something. And literally there was like a split second candle where it was like a 1 minute candle. It went from like $4.50, it wicked up to like 5.30 and then right back down within like the blink of an eye. So it's like it just like wick up like 50 or 60 cents and just stop out everybody who's short, and then it come right back down and keep going. So it's the same thing. I think probably one of the biggest examples was AMC. Like I think that was the first time that all those guys got a taste of that, because I remember everybody talking about it, saying like, "Oh, it's manipulation." Like look at the way, because that there was that one day, I think it was a Friday, the chart was just trading like super thick, like just sideways all day long, like big top and bottom wicks all day, and like it just was like the ugliest looking chart, and like I knew that that was just hedge funds and stuff covering their shorts, and they're just using all their they're just using all their shares to do exactly what we're saying, just get out of their positions and hold in that channel, or they're just loading up or whatever they're doing. But everybody was all upset, like, oh, market makers and manipulation and this and that. And I'm sitting there, I'm like, that's what the stock market is. I mean, that's like you can do that. It's just you have to have enough money.
Yeah.
Like it's not illegal.
Because they don't see the opposite side of it, right? Let's say a bigger enough group has a larger enough money, like it'll just crush them. Like they're going to suffer a loss after that.
Well, like what if I was worth like $10 billion and like I could throw like $1 billion short order on like GameStop, for example, and like just crush that thing down to bankruptcy. Like it's not illegal. I can do that. I just have to have the capital to do so.
And I wonder if like whales will go against each other. Let's say you're trying to push the stock up. You created a buy wall. I'm a bigger whale. I created an even monster sell wall, and everyone starts to push down on you. You know what I mean?
Yeah,
Right? It's
yeah.
hilarious.
Sometimes guys will do both. They'll do the short and the long, and they just like channel it, and they do what you said. They'll just lift one side once whatever position they want is full. So like if they want to go long, they'll bring it down, and then once it gets down to their level, they'll put that huge buy order there with hidden size, and then they'll put a huge sell order right above it, and they'll be accumulating like long and short. And then once they've gotten as want on say on the long side, they'll just lift the short and flip it all to cover orders, and they'll basically just buy out of their short on the way up and just have this massive long position while they're squeezing out all the other guys.
Yeah, you know what's ironic though? Like I know a lot of newer guys like called something like that manipulation, but the way I'm looking at it is that's almost like real price discovery slash fair market, because it's literally like who's in control other than money, right? It's just right. It's so pure.
I know. Well, that's actually kind of the funny thing about like poker playing is like, you can't go to a certain poker tables because it's like, oh, it might have like a $25,000 buy-in or something, right? Whereas like the markets aren't like that. Like it'd be like me with zero experience and $50 in my pocket, sitting down to play against a table that's like $100,000 buy-in, right? Like that's what the stock market is. Like you don't know who you're up against. That's why I always say I don't play against the big guys. I don't play against like the guys that are day trading like Apple and Amazon and stuff like that. Like I play against the guys that are betting on the $10 tables because they're less experienced.
So here you reminded me of another similarity. The tables. The tables and the table stakes kind of have a huge effect on who you're playing. If you go to like, 25 cent, 50 cent table versus like a $2, $2, $5 table versus like whatever, the players are going to be different, right? The 10 and 20 cent table is going to be a bunch of dumbasses who are going to do very irrational things, and those irrational things will fuck you over. Whereas if you
Yeah,
go to like, a very high end table, you could at least count that these guys will be somewhat responsible. So I
right.
think it's like
See that,
yeah. So I think it's a bit of a comparison with low caps and high caps, right?
yeah, that was kind of like the original reason why I didn't get into, like, when we were talking about AMC. That was the whole reason why I didn't get into originally, is because I'm watching this thing trade out, and like I know we kept talking about it, and I was like, you know what? Like I just, with all these Reddit guys who have no experience, I was like, I just don't know what it's gonna do. Like I could see a pattern that's beautiful, but these guys, they don't know how to trade, so they could just make it. They just make everything not work. And like I'm seeing it all like play out now in hindsight. Like because I started trading it later on. I realized that like it didn't matter. Like it still played out the way it was supposed to play out. But like I didn't know that at the time, so I wasn't going to risk my money because I didn't know if there was enough capital with these Reddit guys that they were going to be able to basically just make chart patterns invalid. So
Interesting. So at no point was there something that would confuse you. It looked like it pretty much made sense, eh?
yeah, like you could look back at AMC from the day it started getting all over Reddit, and everything was perfect. Like there was no variances. It was literally just more volume. Like the human side of it still played out exactly the same.
But was the price action surprising? Like the scope, I guess.
The only thing that was surprising was just the volatility of it based on the market cap. Like or like it had like over 500 million share float and like 20% short float. So like 20% short float is high. Like you can get like I don't really like shorting things that are 20%, but a same token 20% short float on like a 500 million share float company, like it's still not gonna like you wouldn't expect that to like squeeze up $5-6 in a matter of like minutes, which it had many times, right? So like aside from that, like it basically all it really did was you just kind of ignore the fact that it said 500 million share float and trade it like it was like 20 million share float, and then it was the exact same thing. Like that's the only difference.
Oh wait, so you're saying even though its market cap or its size was so big, it still traded like a small cap?
Yeah, exactly.
That's awesome.
Just because there was so much volume, right? But like I still see that sometimes. Like I'll see, because like I say, like I like to trade the stuff that's around like 10 to 50 million float, and because they move nicely and they move like with enough volatility you can make money on them. But like some days I'll see stocks that are like 350 million float, but like where a normal day on say a 20 million float stock you get like maybe like 30 million or 40 million shares traded, you might have a 300 million float stock that has like 350 million shares traded. So like it's still trading with the same kind of volume relative to float to make it volatile enough that you can like expect the patterns to work.
That's interesting. So it's like if a bunch of goons rushed the World Series of Poker, just took over all the pros, just outnumbered them with dumbass like
Yeah,
moves.
yeah, then we can win.
It's true. It's like no matter how tight you play, like you can't beat the mob. Like
No, that's the thing, right? That's all literally all it did, which is great because now I know that for next time. So next time we have a Reddit AMC thing, like I know exactly how to play it, which is the same way that everything else works. So I'll be able to make money on more money, I should say.
that's hilarious.
Yeah.
Yeah, that's man. I got a list of fallacies over here. Sam, do you mind pulling up my screen? I just want to go down these, and I just wanted to see if you could recognize any in like trading. We could start with confirmation bias. That's a pretty common one. We believe what we want to believe by favoring information that confirms our pre-existing beliefs. So, I mean,
Yeah.
so I think this might affect newer people more in that they don't know what they don't know. They have a very limited set of knowledge, and so anything fits that data set. I guess they're going to say, "Oh, this must be it."
Mhm.
What do you think?
Yeah, confirmation bias is just like it's tricky when you're new, right? Because you don't know what necessarily is supposed to happen. We've talked about this a million times. Like even with the chat rooms and stuff like that, I think it's so difficult. Like if I was to teach someone how to trade like properly, like I would want to be having like basically like daily seminars with them, sitting them down and being like, this is what you need to look for. This is how this works. these are the specific, these are specific fundamentals you should look at, and like really walk them through. And then if they have a bad trade, like be able to say like, hey, like show me the trade or whatever. Like, okay, this didn't work just because it didn't work. Like everything else you did was right. You stopped out, it was fine. Like everything else was good. Or like, no, you missed this, and then they can go back and say, oh, okay, well, I'll remember that for next time, kind of thing, right?
So, okay. I got one question before we move on to the next one. So, would you say the reason you're not falling victim to confirmation bias now is because you play those specific set of high probability setups that you've spent a lot of time researching?
Yeah.
So there's no bias, obviously, because you have the data to prove it.
Yeah, exactly. You just play what you know works. And like, bottom line, guys, too, is like, people always say, oh, markets are always changing and your patterns aren't necessarily going to work forever. To be honest, I kind of think that's bullshit myself, because like that was something that held me back for a long time. In that, when I would start to see consistency in patterns, like I'd always heard like, oh, the markets change, they're always changing. And I'm like, okay, well, like I got to learn something really fast, because whatever pattern I learn is only going to work for like 4 or 5 months, and then the markets are going to change. I had like this preconceived notion. But like after doing this for, like 4 years now, and like knowing guys that have been doing this for 20 years, like there's guys that have been doing this for 20 years that literally have not changed any of their systems since like, the late 90s, early 2000s. So like the markets change, but they don't, like the setups are still the same because human nature is still the same.
Yeah, I was just gonna say that like as long as you're trading human nature and as long as human nature doesn't change, then I don't think why would anything else change? Why would the market change?
Yeah. So I just kind of want to let people know that if you find a system that's working consistently, the only thing you might have to do is like change your targets, or kind of like tighten up your rules. Like if we go to a bear market and you're a long bias trader, I would say just bring your profit targets down a little bit and like just tighten up, like only play like your top setups, not like the okay ones. But and then if we're in a crazy bull market, you can play like a little bit of, the messier setups and let your profits run a bit longer. But the core setup will remain consistent, basically forever, in my opinion.
I think that's a great point. Like, it's really important to know what type of market you're in, because it does change behavior, right? If there's an overall optimism or overall pessimism.
Mhm.
So let's go to this next one. This one's interesting. Conformity bias. Choices of mass populations influence how we think, even if against independent personal judgments. This can result in poor judgment, poor decision making, and lead to groupthink. So this is, I think, where the media comes into play. Like a lot of people bought the drink the Kool Aid of Nikola, right? CNBC, everybody was all over this company's nuts. They're the next Tesla. They have new battery technology. They have hydrogen, blah, blah. A lot of people buy into this stock. I'm going to get your thoughts while I pull up the chart. What do you think?
Yeah, sure. I'm just looking at our Google thing. It says we only have 6 minutes left before it shuts off.
Oh, all right.
So yeah, look at the chart quick, and then we're probably gonna get kicked off because we're so cheap, guys. We're poor. We can't afford to pay for a Google subscription.
Yeah. We're gonna we'll figure that out. I think I'm gonna have some swag coming out soon. Look at this chart.
Yeah, you need to start donating to us so we can fund our Google subscription.
I know, nothing big. We'll take a little buck here and there, but
It's probably like $6 a month or something. We're just cheap.
yeah, I know. Look at this thing, man.
Oh wow, yeah.
Like it peaked at 95.50 ish. It is at $9. Wow, it's down like 90%.
Wow.
I mean, so not only is this like a great example of groupthink where this is the entire media pushing this hype train up, but you also see denial playing out every time one of these happens. This is denial,
Hmm.
right? Even here, like why? It's already hit like $9, and then for some odd reason, there's got to be some news related to that one. But I mean, this is all denial, right?
It's Man, it's just so hard though. Like especially when you're new, and like even now, like I'm sure you still fall victim to it a little bit every now and again. Like you hear so much stuff of the same thing from everybody, and you start to kind of second guess yourself a little bit. Like it's really difficult. Like it's a skill that takes a long time to master, where you can sit there and have like everybody in the world saying like this is what's going to happen, this is what you should do, like no, you're wrong, no, you're an idiot, why are you doing that, that doesn't make any sense, have you not seen this, look at these news articles. And for you to ignore all that and just say, no, you know what, I'm going to risk my hard-earned money and I'm going to do the complete opposite of what these 8,000 people have just told me on Twitter and sent me all these news articles and all these reports. I'm going to do the opposite. Like that's really hard to do. It's really hard to do. And that
It,
comes back to the confidence thing again, right? Like you have to just be so confident. You just have to ignore all that stuff. It was like again, I just talked about AMC quick, but it was like everybody was talking about like the options gamma squeeze or whatever, right? Like I don't know what that is. I've never heard of it before. It's never affected my trading, and I know that I've traded stocks that have a ton of option interest. So to me, I was like, okay, well, I'm still going to take this trade because even if it goes wrong, then it goes wrong, and I learned something, and I'll look into it. But until then, I'm just going to keep trading it the way that I know to trade it, and I was right. So
so, so I'll give you the perfect example of when I went super against the grain. It was recently. It was the Bitcoin thing where everybody thought it was going to go to like 20,000 or whatever it was, and like that was like I almost stood alone on that when it went long. I know others went long, but like it felt like I was alone there, and it worked out. But it only worked out because excuse me, I felt strongly that I had a an information advantage. Like not only did I look at a legit pattern that was not excuse me, a legit pattern that was not almost recognized by anybody, and also um, that I had the on-chain data. I'm paying for Glassnode, and I was looking at the purchases and I was looking at the sells, and I was like, all the accounts, anybody that needed to sell have sold. So I don't know where the downward pressure is coming from, but I know there's a lot of hungry people waiting to jump back in. And the second they start to sniff that this thing is turning around, they're probably going to pile on, right? And so, but that was like once in a blue moon. Usually, if the whole world is saying no and I was thinking yes, assuming I'm not in that asset, I just won't move. I won't make a decision either way
mm,
because it's just too confusing. I'd rather stay out.
yeah.
Yeah, and don't worry about Google. I just for 14-day trial, I started it.
Oh, really? So we're good now?
We're good. Yeah,
Beauty for 2 weeks.
yeah. And then authority bias, favoring authority figures, opinions lead. Yeah, so this is the same thing,
Yeah.
like news outlets, whatnot. Loss aversion. Oh, I think that one's interesting. Once a decision has been made, sticking to it rather than taking risks due to the fear of losing what you gained in starting something and wishing to see it finished. We also attach more value to something once we have made an emotional investment in it. So, do you
Yeah.
want to give an example of this?
I think probably the best example of that is taking profits too soon, especially if you're thinking about a new trader, because I do that a lot. I still do it a little bit to a certain degree, but not nearly as bad as I used to. But like, you know, I think anybody who's been like tracking trading or trying to get into trading for like a few months, they probably have like a general idea of like maybe one pattern they're kind of looking at, and they probably have some stuff they've seen where they're like, okay, like if I see this, I'll get in here and I'm going to sell it here, right? Like just kind of a rough structure. But what happens is like you take so many losses learning how to do stuff that like when you get in, it's like, it goes the tiniest bit green and it's like 20%, like 20% of the way to your target. And you're like sitting there and you're like, okay, I'm out. I'm just taking the money. I'm out. Right. And then you take it and it's like, oh, fuck, you lose. And what happens is, it'll go up to your target. But then the shitty thing about that is what usually ends up happening is because, I know at least for me anyways, like, excuse me, I set up my data sets based on, like right now, like the pattern that I play now has like over a 90% win rate. But like some of the other patterns I've set up, it's like, okay, let's say it has like a 70% win rate. Then I know that when I take a loss on this, each loss on average is say like half of what the average win is, right? Based on my data. Because I'm saying like, okay, like every time I see this pattern, if it works, it goes to this level. If it doesn't work, it goes to that level, and I'm out for half. So like I know based on those numbers that I should be making money overall if I take every one of these trades. But what happens and like what, it took me a long time to pick up on, I think a lot of people probably are in the same boat, is you can have that data, but then you'll have a trade that works. And instead of letting it run the full way to your target, you'll take it off at like 50% or like 30% profits because you've taken losses and you're still not really sure. So now all of a sudden you're looking at a pattern that's, it works 70% of the time. And, and your losses on the other 30% or 50% of what the average win was, well, your average win now is so much smaller that really, those losses are now probably over 100% of what your average win is. So now the pattern doesn't work anymore because your losers are going to be bigger than your winners. even though the data says something different, you're not trading it and you're not executing it correctly to make those probability numbers work for your benefit.
Yeah, that's a really good point. That's a really good point. Would you say so? I guess the only solution to that is experience. I mean, I don't know if more knowledge is going to help.
Well, from like my own personal experience, I would say the best thing to do is to take off like, if you're still like really like skittish, trying to like make money and stuff like that, I would say take off like 70% of your position, like when you're in the money a little bit, just to kind of like make yourself comfortable and like, take it so that if it hits your stop loss, you're out for zero. And then you can leave, your last, 30 or 20 or even like 10% of your position. Like even if, it's going to run all the way to the end and it's going to make you another like $3 if you let that piece go, like just the mental aspect of letting that last piece, that last cover or that last sell get to that level before you hit sell and just getting those mechanics down is going to be a huge help. It's not the money thing. It's just like it's just a mechanics thing.
So building confidence just through experience, building in the move.
Yeah, if you're still nervous, like take off most of your position for a couple bucks and let like literally even one share, like just let it go to that level, just so when you look at that chart, you can see that last sell on the level you wanted it to be, and then you're gonna look at that and say, okay, well, I know how it felt to wait that long now. Like I know what it was like. I know what the price action was. Like it just has to become a mechanics thing.
This one's really interesting. False causality bias. Citing sequential events as evidence the first caused the second. This can occur within the design thinking emphasize phase, where you are intentionally seeking confirmation, causality between what people say and what they do, leading to taking the wrong problems. Okay, so I got an example of this. In the abstract, let's say a CEO says he's going to perform, the company's going to perform a certain way this year. Or by the end of this year, the company will have this much revenue. And then at the end of the year, the company has something within that range. So you think, okay, well, he said it, he must have done something, hit the target. But look at how much you don't know in that whole story, right? It's really easy to say something, and then it's really there's a lot of issues that could apply where what he did had no bearing on the result. Those other things, outside forces, was what brought it to this result. And so, like, it looks like A plus B equals C, but then it really is not, right? So a lot of times it's like, it's really hard to judge unless you have more information, but it's really easy to like, I think the danger with this is like, it's just assuming A plus B equals C because you saw something like that show up, and then going forward, you always think, okay, well, if a CEO says the target's going to be this by the end of the year, it's probably going to be this, and you're going to be wrong, right?
Mm-hmm. Yeah, I think a lot of people probably got that, like even just in 2020, like that whole false causality thing, because maybe it's not the exact same thing, but just the fact that we were in probably one of the craziest bull markets ever. We had so many people that were just buying stuff because it was going up and buying stuff because there was these news reports coming out, and then now we're into the next year and it's not working anymore. So like that's the same kind of thing, I guess. A lot of people are reading stuff and they're seeing what earnings are, and they're seeing all these like overinflated numbers and like artificially pumped up stocks and thinking like, oh, this is great. Like, this just works every time. But then things start to change a little bit and all that just kind of falls apart because there was no real cause for the trade in the first place. It was just basically, you just jump in because you jumped in. Everybody's talking about it.
Actually, I got a great recent example. I just thought of this because somebody messaged me about it. So remember the narrative earlier in the spring? It was all in over news, bonds. If bonds sell off, there's an inverse relationship with stocks. So then if bonds yields are going up, then stock prices will go down, right? Well, that was true at first. Where my buddy got screwed was that he thought that was true and bet that way. And then there was a period where I think it was May where bonds went up, bond yields went up, and so did stocks. And he got fucked because he sold his position. And so, is there a correlation? Remember, I showed you, I have that indicator on my chart that I use sometimes, which shows correlation. I'm like, there's like a very loose correlation between bonds. Like, well, not loose, but it's like 80%. It's like 0.8, 0.8. And so, like, there's 20% of the time it's not true. And if you made your bet that 20% of the time, you got fucked.
Yeah. Yeah, it just depends on what the loss is that time, right?
Yeah.
Yeah. With anything, your odds of winning are 80% and 20% loss. You just have to make sure that whenever you do have that 20% loss, it outweighs the 80% of the time you win. And then
See,
That's it.
it's natural for you to think like that, but like I think everybody started out. It's like all in, all out. It's like if you're all in, all out, that 80% is not your friend.
No, no. Unless it's 100%, but I haven't found something that works 100% of the time yet.
Yeah, exactly. What's action bias? When faced with ambiguity, favoring doing something or anything without any prior analysis, even if it is counterproductive. Yeah, I think we know this one well.
Yeah, we could probably just skip right over that.
All right. So, self-serving bias, favoring decisions that enhance self-esteem. Oh, Michael fucking Burry. I'm going to use this as an example. He hasn't been proven wrong yet, but he hasn't been proven right, and it's not looking good for him. The guy took a short in Tesla, and he took a short in ARK Invest, and he's betting that bond yields will go up significantly, um, or down. I can't remember which it was. He made a really asymmetric bet where it's like, if he's wrong, he's gonna lose big.
Hmm.
And so the reason I bring him up is because I think he's drinking his own Kool. Like he was absolutely right in the '08 financial crisis, but that was because he saw something other people didn't in that data, right? He knew mortgages were gonna default, so that was the catalyst. His only thesis about Tesla is that it's worth more than he thinks it's worth. A lot of things are. What does that even mean?
Yeah.
Because you think it's worth more? Like, no.
That's a terrible idea. I mean, you want to have your own, like, you want to have your own decision and your own like bias on a trade, but as soon as it goes wrong, you have to be able to immediately, shut that off and cover your position or cut your loss, right?
And I just want to point out that I think Tesla's up something like 15 to 18% since he made his famous tweet. So, and the thing is, he's not short the stock. He bought puts, and so not only does he have to be right, but he has to be right about the time, the expiry date too. So he's losing value every day.
No thanks.
Yeah. So let's go to frame bias. Being influenced by the way in which information is presented rather than the information itself. I mean, I could see this as being there's could be a bunch of ways to see this. Nicola's a good one where it's like if you just look at them on the surface, they looked exactly like they were selling themselves to be, and you have to kind of look deeper to realize that there's something wrong. Um, yeah, I think the only way past this is just to have more information. I don't know if it applies to trading though.
Um, a little bit. I think just like a news, like the first thing that comes to mind is just news releases. Like I know I mentioned one of the ones before where it was like this small cap company made a press release the one day that said we're now selling our products on Amazon, and it like shot way up. But if you like literally just clicked on the link of the article, it gave you the date when that happened, which was like a year and a half earlier. So it was like completely irrelevant news, and then it sold right back off. So
That's a good one. Oh, I
yeah.
got a good one. Being influenced by the way in which the information is presented. Just last month, every news outlet was like Tesla China sales, car sales was cratering. And it looked
Oh
like it if
yeah.
you only looked at China's data, right? It went from like, 20,000 units down to like 8,000. They're like, oh, you think, okay, well, shit, they just lost 12,000 sales. Well, they exported like 25, 30,000.
Yeah.
They have, they're making 35, 40,000 a month, and they're selling out every month. The issue is, where is it going?
Yeah. When their sales were like double or something, weren't they? What they were supposed to be?
Dude, by the end of this year, their sales, despite the chip shortage and a battery shortage, are probably still going to be up 50% year over.
That's insane.
Ambiguity, favoring options where the outcome is more knowable over which it is not. That feels like trading, but I can't think of an example.
Nah, skip that one.
Strategic misrepresentation, knowingly understating the cost and overstating the benefits.
Well, that just comes down to your percentages, right? What's your loss and win percentage?
Yeah, that's a good one. That's a good one. Bandwagon bias, a commonly known bias favoring ideas already adopted by others. Self-explanatory.
Yeah.
Projection
Holy shit,
bias.
how many?
We're done.
Oh, we're almost there.
Last four.
Okay.
5. Yeah. A commonly known bias favoring ideas already adopted by others. These are kind of the same. From behavioral economics, over predicting future tastes or preferences will match current tastes. I could EV this all day. So all the analysts love predicting the future of EVs. So the best analysts in the world are saying by 2040, maybe 50% of cars on the road will be EVs. That's analysts. And the reason they reached that number is because they're using a linear progression. But the adoption curve is an S
Yeah,
curve,
for sure.
right?
Yeah.
So at some point, the majority is going to catch on, and then it just escalates, right?
Mhm.
So the first 20 takes a while, the middle 60 just boom, and then the last 20 takes another while, and so that's
Yeah.
projection bias.
Well, it's
Um,
like UK said, and I think that article we read, New York now has mandated, I think 2035, they're not selling new gas vehicles.
yeah,
Everything's getting zero emissions. So you got what, 14 years before you can't buy a gas vehicle in New York and in Europe.
actually, let me paint the timeline. Maybe we could stop it with the next one, but I want to paint the timeline with this one. So, 2 years ago, China went out and said we want all in sold in China to be sorry, we want all cars in China by 2035 to be EVs.
Okay.
So prior to that announcement, what analyst would have predicted that? And China is the largest car market in the world. And so if an analyst can't predict that, obviously your chart's going to be wrong. So that boom just set EVs to another course, right? And then that
Yeah.
California announcement, boom, set EVs because they're like the largest state car
Yeah.
market. And then just recently, California said by 2030, all ride-hailing companies need to be 80% EV. And then Lyft and Uber said we're going to be 100% by 20.
It's going
And
to be everywhere, man. It's
this is
going to
all
be,
within like a 6 month period.
yeah. I get like my advice to anybody would be like, if you can afford it and you're next time you get a new vehicle, just get an electric one because it's going to force your hand if you don't.
Actually, so I got something. So somebody messaged me last night, like, yeah, I love Teslas, but I wish they made a cheaper car. And I saw a projection by a guy who's actually pretty good at predicting the future because he understands this S curve thing. And he drew a different curve. He drew a cost curve. And basically, he predicted, I think 5 years ago, where the cost of batteries in cars would be today. And then 5 years ago, they said he was nuts. He's like, there's no way you're going to get a 200-mile EV at $35,000. You do. It's the Model 3. And
Yeah,
so his projection is that by 2025, there's going to be a $10,000 EV with 200-mile range, which is 330 something kilometers.
that'd
So
be
within 4 years, you know, if the trend
yeah.
continues, so it's coming. Which one you want to touch on?
Uh,
I think anchoring is interesting.
yeah, most of these are pretty self-explanatory. Yeah, let's go over anchoring, the last one, then we'll wrap it up here.
All right,
Premium
anchoring. I'm
by
sorry, you can go ahead.
information already known more that's first shown. Yeah, see, like again, that just kind of takes me back to that Amazon example where everybody already knew their product was on Amazon, but they just made a press release about it.
I think in terms of chart patterns, I could go back to the Bitcoin one. Everybody and their mother was calling for a fucking Head and Shoulders. Remember, for months there was Head and Shoulders. I'm like, and the more it played out, the more I realized it was not likely to happen. And then,
Yeah,
so and remember, even me, like I even changed my mind. I was like, well, okay, maybe the Head and Shoulders is playing out. I took a small short position in that ETF because I think what's that thing you always say, like we need to be able to change our minds. It was a good way to put it. You had.
have a good quote. I don't remember. You
Just the way
basically,
you yeah, just the way you worded it was good, but it was basically the idea that you
well,
want to be able
you
to
gotta be confident in your decision, but you also have to immediately be able to accept when you're wrong.
yeah, yeah, that's exactly it. And I think everybody anchored onto that idea where we have a Head and Shoulders, it's infallible, there it is, and like let's bet
Yeah,
against this thing, and then yeah, I got fucked.
yeah. All right, should we end it on that note?
Yeah, let's wrap it up. All right, goons, thank you for watching, and please send us any questions or comments. We'd love to answer it for you.
And send us donations so we can afford Google.
All right, have a good one.